Something interesting happened in gold this week, and almost nobody is talking about it the right way. The headlines are screaming one thing. The charts are whispering something completely different. And if you're holding gold or silver, or even thinking about getting involved, you need to understand what's actually happening beneath the surface. Because right now, the market is playing a game. And most people don't even realize they're being played. I wasn't planning to make this video today. I had other things on my schedule, normal life stuff. But then I sat down, looked at the charts, checked the data, watched the tape, and I thought, no, this needs to be said. Because the convenience story is already spreading. The easy explanation is already making the rounds. And if you buy that explanation without questioning it, you might make a decision you regret. So here we are. It's a new week. Before we go any further, drop a comment telling me what day and date you're watching this from. I'm curious how long this video stays relevant because the principles we're going to talk about today, they don't expire. They work in any market environment. But the specific setup we're looking at right now, that's time sensitive. That's happening in real time. And I want you to track how this plays out. Also, quick thing, if you're new here, this channel is focused on one thing, helping you understand currency, money, gold, silver, and the forces that move them. Not hype, not hopium, not doom and gloom for clicks. Just honest analysis that helps you think clearly when everyone else is panicking. If that sounds useful, subscribe, and let's build something here. Now let's get into it. Here's what most people are seeing right now. Gold pulled back. Silver got volatile. The dollar did something. And suddenly, everyone has an opinion. Everyone has an explanation. Everyone knows exactly why it happened. And that should be your first warning sign. Because when everyone agrees on a narrative too quickly, that narrative is usually wrong. Or at least incomplete. And let me tell you how markets actually work. Because this is the part they don't teach you. The part that separates people who consistently make good decisions from people who consistently get shaken out at the worst possible moment. Markets don't just move price, they move attention, they move emotion, they move narrative. And the narrative is often a tool. It's used to justify moves that already happened. It's used to create urgency. It's used to make you feel like you need to do something right now. But here's the thing. Urgency is expensive. Panic is expensive. Acting without understanding is expensive. And the market knows this. The market is designed to trigger your emotions. It's designed to make you feel smart when the line goes up and stupid when the line goes down. And somewhere in the middle of all that emotional chaos, the only people consistently winning are the ones who can keep their brain from doing gymnastics. So when you hear words like volatility and uncertainty and wild swings, I want you to translate those into something more useful. What volatility really means is liquidity is thin in spots. It means leverage is getting squeezed. It means headlines are being used like steering wheels. And it means the market is testing where the weak hands are parked. That's not a moral judgment, by the way. You can be a smart person, an educated person, a careful person, and still get shaken out if your position is sized wrong or your time horizon doesn't match what you're trying to do. Getting shaken out doesn't mean you're dumb. It means you got caught in a trap that was specifically designed to catch you. And gold is particularly good at setting these traps. Because gold doesn't behave like a normal stock. A stock has a story that changes over time. Earnings reports, product launches, management changes, scandals, acquisitions. The narrative evolves constantly. Gold's story is older than all of us. Gold's story is trust. Gold's story is what happens when people start questioning paper promises. And that story doesn't need a new chapter every week. It needs the old chapter to remain true. And right now, the old chapter is more relevant than ever. Now I'm going to give you a framework you can use in any market, any asset, any situation. Whenever price does something emotional, whenever you feel that urge to react, ask yourself this question. Did reality change or did positioning change? Because reality changes slowly. Reality is about fundamentals, about supply and demand, about what's actually happening in the world. And that stuff moves like a glacier. You can watch it for weeks and barely notice the shift. Positioning changes in an afternoon. Positioning is about who's long and who's short, who's leveraged and who's not, who's trapped and who's comfortable. And when positioning gets too one-sided, the market corrects it. Not because reality changed, but because the crowd got too heavy on one side of the boat. And that's what I've been watching over the last few weeks. A whole lot of positioning behavior. I've seen people who chased the move get trapped. I've seen people who swore they would hold forever suddenly discover what a stop loss feels like. I've seen the buy the dip crowd go quiet for a minute. In that quiet moment, that's usually when the next opportunity starts forming. So let's talk about what actually happened. Not the headline version, the real version. Or at least as close to real as we can get from the outside. Gold ran hard. You saw it. Everyone saw it. New highs were in the air. Excitement was building. Social media was full of people calling for even higher targets. And whenever you see that kind of consensus forming, your antenna should go up. Not because the crowd is always wrong, but because the crowd, being uniformly excited, creates a setup for disappointment. The market doesn't like it when everyone agrees. The market likes to punish consensus. It likes to create doubt at the worst possible moment. It likes to make you question everything right before it does what you originally expected. So gold pulled back. And suddenly the narrative shifted. Suddenly it wasn't about new highs anymore. Suddenly it was about all the reasons gold might fall further. The dollar, interest rates, central bank policy, pick your poison. There's always a reason available if you want to be bearish. There's always a reason available if you want to be bullish. The reasons are just decoration. The real action is in the positioning. Now here's where it gets interesting. And this is the part most people are missing. Gold pulled back, yes. But it pulled back into a zone that matters. It tested levels that serious traders watch, and then it did something that tells you who's actually in control. It held. Not perfectly, not without some drama, but when the dust settled, buyers showed up. Not the desperate buyers who chase every bounce, the kind of buyers who step in when price reaches a level they've been waiting for, the kind of buyers who understand that pullbacks within a trend are opportunities, not disasters. And I want to break down what holding looks like because it's not just about a number. It's about behavior. When gold tags a key level and then immediately bounces, that's one type of hold. Quick rejection, buyers aggressive. When gold tags a key level and consolidates there for a while, building a base, that's another type of hold. Slower absorption, buyers patient but persistent. What you don't want to see is gold tagging a key level and then slicing through it with conviction. That's not holding, that's breaking. And when a level breaks on heavy volume with follow through, you have to respect that. You have to acknowledge that the character of the market may have changed, but that's not what happened here. At least not yet. What happened was a test. The market reached down. It checked if sellers could push further, and sellers couldn't sustain it. That tells you something. That's information. Now, does that mean gold goes straight up from here? No, markets don't work that cleanly. Gold could chop sideways for weeks. It could retest that low. It could frustrate both bulls and bears before making a decisive move. That's normal. That's what healthy markets do. They consolidate. They digest. They shake out the impatient before rewarding the patient. And if you're the kind of person who needs fireworks every morning, that consolidation phase will feel like nothing is happening. You'll get bored, you'll get antsy, you'll start looking at other things, and that's usually exactly when the move starts. So the first thing I want you to understand is that pullbacks are not the same as trend changes. A pullback within an uptrend is the market catching its breath. A trend change is something else entirely. And the difference shows up in the behavior around key levels. Right now, the behavior is suggesting pullback, not trend change. But I want to be honest with you. Suggesting is not the same as guaranteeing. We're reading probabilities here, not certainties. And anyone who tells you they know for sure what's going to happen next is either lying or delusional. What we can do is stack the evidence, look at what's happening in the bigger picture, look at what's happening with the dollar, look at what's happening with policy expectations, look at what's happening with demand, and then make a reasonable assessment of what's more likely. So let's do that. The dollar matters. I'm not going to pretend it doesn't. When the dollar strengthens, gold often faces headwinds. When the dollar weakens, gold often catches a tailwind. That's the basic relationship. But the relationship is not mechanical. It's not one-to-one. There are periods when gold rises, even as the dollar strengthens. There are periods when gold falls, even as the dollar weakens. The correlation is real, but imperfect. And here's the thing, people forget about the dollar. The dollar can bounce for reasons that have nothing to do with long-term health. It can bounce because traders got too one-sided on the short side. It can bounce because of end-of-month flows. It can bounce because risk-off sentiment drives money home. A bounce is not a diagnosis. A bounce is just movement. So when someone tells you the dollar bounced, therefore gold is finished, that's like saying it rained today, therefore summer is canceled. That's not how cycles work. You have to look at the bigger picture. You have to ask whether the structural forces that were pushing gold higher have actually changed, or whether this is just noise within a larger trend. And when I look at the structural forces, I don't see a lot that's changed. The debt situation hasn't gotten better. If anything, it's getting harder to pretend it's under control. The fiscal picture hasn't improved. The refinancing pressures haven't disappeared. The geopolitical tensions haven't calmed down. The demand from central banks hasn't evaporated. These are the forces that created the gold move in the first place. And unless those forces reverse, the trend has a foundation. That doesn't mean straight up. It means the basic thesis remains intact until proven otherwise. Now let's talk about what the charts are actually showing, because I know some of you want the technical perspective. And I think technicals matter, not because lines on a chart predict the future, but because lines on a chart tell you where other people are paying attention. And when enough people pay attention to the same levels, those levels become self-fulfilling. Gold has been respecting its short-term trend references. The 50-day average, which is a line that trend traders watch closely, has been acting like a magnet, Price dips below, buyers show up, price recovers. That's the pattern. And as long as that pattern holds, the short-term structure is constructive. Now, if you zoom out further, gold is still well above its longer-term averages. It's still in a higher high, higher low pattern on the bigger time frames. It's still doing what a healthy uptrend does, pulling back, consolidating, and then continuing. The question is whether this pullback turns into something more. And the honest answer is, we don't know yet. We're watching. We're gathering evidence. We're looking for signs that either confirm the uptrend or warn that something has shifted.